when the numbers get huge on both sides and you get small changes in these huge numbers, they have this incredible effect on quarterly or yearly figures because it all comes lumped in. Those adjustments come lumped in a short period of time. So I just think you have to accept the fact that insurance, banking, finance companies, we've seen all kinds of finance company, both frauds and just big mistakes over time, just one after another over the years. And it's just a more dangerous field to analyze.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Uhl. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Markets are people. People are predictable. Outlier can show you how to track market fear and greed with artificial intelligence on over 1,300 of the largest market cap names. Visit outlier.com to learn more. That's OVTLYR.com. They have a free pilot program for the rest of 2021 so you can get access to right now at OVTLYR.com. That's OVTLYR.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, very interesting. We're going to be hearing a question that Bill Ackman asked of Warren Buffett and Charlie Munger. Bill Ackman is the legendary investor of the, he shorted Herbalife and it went majorly against him. Hang on, give me 2 seconds. I'm going to Google it real quick. Bill Ackman Fund. Bill Ackman is the, there was a movie on him. There it is, Pershing Square Capital Management. That's the one I was thinking of, sorry. There was a movie based on his exploits called Betting on Zero. And yeah, according to this, Ackman's horrible, terrible, no good, very bad, billion-dollar losing investment. So interesting, because this video we're about to watch is a question where Bill Ackman is asking Warren Buffett and Charlie Munger something. So I have not seen this yet. I'm watching it cold. So I'm going to jump right into it.
Thank you. Bill Ackman from New York, New York. For the handful of AAA-rated companies, AIG, Fannie Mae, Freddie Mac, and MBIA, are under formal investigation for accounting shenanigans and are in the process of restating their financials. Like Charlie said before, I think of a AAA-rated company as an exemplar, a company that should behave with the highest accounting and ethical standards. My questions this leads me to are, how can investors comfortably invest in any financial service company when a decent percentage of the AAA-rated companies have false and misleading financials? And I guess the follow-up question is, why don't the rating agencies do some independent due diligence from an accounting standpoint so that they can help serve as a watch on this issue?
So clearly this is probably around the 2007, 8, 9 timeframe. And we're going to be talking about how to analyze financial statements, which is not something I ever do. But their type of fundamental investment style, they do. So I'm curious to hear what they say.
Well, financial companies are more difficult to analyze than many companies. I mean, it is more. If you take the insurance business, the biggest single element that is very difficult to evaluate, even if you own the company, is the loss adjustment expense reserve, and that has a huge impact on reported earnings of any given period. And the shorter the period, the more the impact can be from just small changes in assumptions. We carry, we'll say, $45 billion of loss reserves, but if I had to bet my life on whether $45 billion turned out to be a little over, a little under, I mean, it'd be I think a long time, and you could just as easily have a figure of $45.5 billion or $44.5 billion. And if you were concerned about reporting given earnings in a given period, that would be an easy game to play. In a bank, it basically is whether the loans are any good. And I've been on the boards of banks, and that's I've gotten surprises. It's tough to tell.
All right, so I have worked in corporate finance for a long time, and I can tell you the way that financial institutions make money. Here it is. Are you ready? They take deposits and they pay, let's say they pay 5 basis points to you. So every $100 you deposit, they'll give you a nickel. Big return, right? They take the deposits, and then they take those deposits and then go out and make loans and their own investments. So they'll take the money that they are, giving you a nickel for, and they'll go out and they'll earn, let's call it 4 or 5% on a car note. Let's call it 3.5-4% on a mortgage. Let's call it 3% on their own investment. So they're taking your funds and making 100, 200, 300% on your funds. But they're also taking the risk financially that somebody won't pay back the car note. Somebody won't pay back their mortgage. Somebody the investment they're making will for some reason default. But they do have very sophisticated financial models to go along with all of that. And for example, like car loans, there's a very, very small percentage of car loans that don't get paid. So let's say out of a basket of 100 car loans that the institution has made, maybe 2 default, maybe 3. And that's just part of doing business. But, they're making so much money on everything else in the meantime. So just a side note, as we're talking about financial
it's financial companies. If you're analyzing something like WD-40, or See's Candy or our brick business or whatever, they may have good or bad prospects, but you're not likely to be fooling yourself much about what's going on currently. But with financial institutions, it's much tougher. Then you throw in derivatives on top of it. And
derivatives probably meaning options.
No one probably knows, perfectly what some of it, or even within a reasonable range, the exact condition of some of the biggest, banks in the world. But that brings you back to the due diligence question of the agencies. You had very high grade, very smart, financially smart people on the boards of both Freddie and Fannie, and yet, one was $5 billion and one was apparently $9 billion. Those are big numbers, and I don't think those people were negligent. And it's very, very tough to know precisely what's going on in a financial institution. Charlie and I were directors of Solomon, and Charlie was on the audit committee, and I forget the size of a few of those things that you found, but what wasn't found. And that doesn't mean the people below are crooks or anything like that. It just means that it's very tough with thousands and thousands and thousands of complicated transactions, sometimes involving the computations, involving multiple variables. It can be very hard to figure out where things stand at any given moment. And of course, when the numbers get huge on both sides and you get small changes in these huge numbers, they have this incredible effect on quarterly or yearly figures, because it all comes lumped in. Those adjustments come lumped in a short period of time. So I just think you have to accept the fact that insurance, banking, finance companies, we've seen all kinds of finance company, both frauds and just big mistakes over time, just one after another over the years. And it's just a more dangerous field to analyze. It doesn't mean you can't make money on it. We've made a lot of money on it, but it's difficult. Now, obviously, a GEICO, where you're insuring pretty much the same thing, auto drivers, and your statistics are much more valid in something like that than they will be if you're taking something that like asbestos liability. You're subject to far greater errors in estimation. Doesn't mean that people aren't operating in good faith, but I would just take the asbestos estimates of the 20 largest insurance companies. I will bet you they're way off, but I don't know in which direction. And that's sort of the nature of financial companies. I wouldn't.
He's talking a lot about the actuarial tables that the companies use. We talked a minute ago about like on a basket of 100 loans, 3 of them may default. But during this time, this 2007, 8, 9 financial crisis here, a lot of mortgages defaulted. Not that it's funny, but when you're expecting 2 or 3 and 20 or 30 come through or more, it's a huge deal, and that's what he's getting at there. And as far as the insurance business goes, right? They have actuarial tables to adequately take on the risk of an insurance contract, right? For cars, because they have so much data, but not so much on asbestos, right? There may only be so many asbestos claims but each one of those claims may be astronomically more expensive than one car insurance claim.
Fault the rating agencies in terms of not being able to dig into the financials and find things that all of the companies that you talked about have had big name auditors, and our auditors at Berkshire, how many hours did they spend last year? I don't know what it would be, probably 60, 70,000 hours. And I'm sure at other, if you take major banks, they're spending more than that. But, can they be certain of the numbers? I doubt it. Charlie?
Yeah. Warren is obviously correct that where
He's
you've
obviously
got
correct. He's Warren Buffett.
complexity, which by its very nature provides better opportunities to be mistaken and not have it come to notice, or to be fraudulent and have it not be found out, you're going to get more fraud and mistakes than you are if you're selling a business where you shovel sand out of the river and sell it by the truckload. Just as a business that sells natural gas is going to have more explosions than a business that sells sand, a business like these major financial institutions, by its nature, is going to have way more problems. And that will always be true. And it's true when the financial institutions are owned by governments. In fact, some of the worst financial reporting in the world is done by governments, and governments, institutions like government banks in China, etc. So if you don't like the lack of perfect accounting in financial institutions, you're in the wrong world.
Okay. Interesting choice of words from Charlie Munger there. He's talking about the inherent risk that comes along with certain aspects of the banking world, right? For example, you make an auto loan for 5 years. A percentage of those will prepay. So the average life of that might be around 3 years, maybe 4 years. But the average life of a 30-year mortgage is going to be significantly more. Even if they pay faster, the average life of that mortgage is not going to be 3 years. And so inherently, the mortgage has higher risk because of the nature of the asset, right? The mortgage has a lot more that can go wrong over 30 years or 17 years or whatever the average life is, versus one car note where it could go wrong over the next 2, 3, 4, 5 years. So yeah, to Charlie Munger's point there, there's inherent risk in these type of assets that is completely different than shoveling sand out of a river. Good example there. So hey, I hope you found this useful. I know I love this series where we can learn from some of the most brilliant minds in the world in our space. And if you found it useful, smash that like button until it's just absolutely destroyed. That'd be awesome. And share it with somebody that you think could use this as well. And be sure to subscribe. That way you never miss any of the tools, tips, and tricks we upload every single week to help you trade faster and trade smarter. I'll see you on the next episode. Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning and how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.